Hello, everyone, and welcome back to Financial Podcast. I'm Olivia, and today we're taking a deep dive into the recent performance and outlook of a major retailer, Target, ticker symbol TGT. The company recently reported its first quarter 2025 results, and these results have certainly prompted a revised outlook for the rest of the year. Analysts and the market are definitely paying close attention to the challenges Target is currently facing. Let's start by unpacking the key financial figures for the first quarter of fiscal year 2025. According to the reports, Target's net sales for the quarter came in at $23.8 billion. This figure represents a decrease of about 2.8% compared to the $24.5 billion they posted in the same quarter last year. So, right off the bat, we're seeing a dip in sales year over year. Now, looking at earnings per share, the GAAP EPS, which stands for Generally Accounting Principles Earnings Per Share, actually went up. Target reported a Q1 GAAP EPS of $2.27, an increase from $2.03 in the year-ago period. On the surface, that sounds positive, right? However, it's crucial to look at the adjusted EPS as well. The adjusted EPS figure came in at $1.30. This is where we see Target missing Wall Street's expectations, which were higher, somewhere in the range of 1.61 to 1.65, depending on the source. The divergence between the GAAP EPS and the adjusted EPS is significant, and there's a specific reason for it. Target's operating income for the quarter hit $1.5 billion. This marked a big jump, a 13.6% increase compared to the previous year. While this seems contradictory to the sales dip and the miss on adjusted EPS, it becomes clearer when you factor in why. A huge driver for that increase in GAAP operating income and consequently GAAP EPS was a $593 million pre-tax gain from settling a credit card interchange fee litigation. Okay, a one-time event significantly boosting those numbers. So while the operating income looks strong on the surface, the core operational picture, stripped of that unusual item, isn't quite as robust. The adjusted EPS figure, which excludes gains like this litigation settlement, gives a better sense of the core business performance. Delving deeper into the sales performance, comparable sales, which measure sales from stores and digital channels open for at least a year, decreased by 3.8% in the first quarter compared to the year-ago period. This overall decline is a key indicator of the challenges Target faced. Breaking that down, comparable store sales saw a pretty significant drop, falling by 5.7%. That's a noticeable drop in physical store performance. However, their digital comparable sales actually grew, increasing by 4.7%. So we're seeing a real divergence here. Fewer people buying in physical stores, it seems, but online sales are still climbing. This definitely suggests an ongoing shift in consumer behavior favoring digital channels, at least to some extent. Looking at overall customer activity, the total number of transactions across Target stores and website dipped by 2.4% during the quarter. And on top of that, the average amount each customer spent per transaction also went down by 1.4%. So fewer people shopping, and those who are shopping are spending slightly less each time, on average. That seems to be the picture painted by those numbers. Despite these dips, interestingly, Target's other revenue stream saw a pretty good jump, up 13.5%. Regarding profitability margins, the gross margin rate was 28.2% in Q1 2025. That's actually down slightly from 28.8% in the same quarter of 2024. Target pointed to a few reasons for this dip: higher markdowns, likely to move inventory, and increased costs tied to digital fulfillment, getting those online orders to people, as well as general supply chain cost pressures. So, costs are indeed eating into the profit margins a little. Selling, general, and administrative expenses, the SG&A costs, if you exclude that litigation gain we talked about, the SG&A expense rate was 21.7%. Net income for the quarter came in at $1.04 billion, which works out to that $2.27 per share under GAAP that we mentioned earlier. This is up from last year's $942 million, or $2.03 per share, but again, that comparison is heavily influenced by that one-time litigation gain boosting this year's number. Now, let's try to understand the why behind this performance. What were the big factors influencing these results? Well, a major theme cited is definitely weaker spending on discretionary items, or non-essentials. Consumers are just being more cautious. Target specifically called out a sales decline back in February being tied to economic uncertainty. People are pulling back on things they don't absolutely need. This caution is reflected in broader consumer sentiment, which had been declining for 5 straight months leading into this period. When people feel less certain about the economy, they tend to focus more on needs versus wants. Target's business model is particularly sensitive to this, as more than half of its merchandise is discretionary and at risk when consumers rein in spending. It's quite telling that Target tracks performance across 35 different merchandise categories internally. According to CEO Brian Cornell, they only managed to gain or even just hold their market share in 15 of those 35 categories during the quarter. Wow, less than half. That really shows how selective shoppers are being right now and highlights a very tough competitive environment where consumers are picking and choosing very carefully. Another pressure at play that was heavily discussed is tariffs. There is real concern about potential future tariffs, which CEO Brian Cornell referred to as massive potential costs. This uncertainty about tariffs adds significant cost worries. About half of what Target currently sells is sourced from the U.S. However, about 50% of their products are imported from overseas. China is a major production hub for Target. While Target has been actively working to reduce its reliance on China for its private label brands, going from about 60% sourced from China in 2017 to about 30% today, and planning to reduce it further to 25% by the end of next year, imports from China still have a significant duty, specifically a 30% duty. This leaves Target in a challenging position regarding potential tariff impacts, which could affect pricing and supply chain dynamics. So, how is Target planning to handle that if it happens? They did indicate that price increases on some items are likely, yes, to help cover tariff-related costs. However, Target executives emphasized that price is the very last resort. They're trying to minimize the impact of potential duties through a whole toolkit of mitigation tactics. This includes negotiating harder with their vendors, reevaluating the merchandise they sell, changing the country that produces items to avoid specific tariffs, and even adjusting the timing of orders. Chief Commercial Officer Rick Gomez noted that Target has spent recent years shifting private label production to countries beyond China to reduce reliance on a single region, an effort that is ongoing. While cost pressures related to tariffs are expected to continue in the second quarter, Chief Financial Officer Jim Lee said that the company expects greater relief in the second half of the year. Despite these cost pressures, offering lower-priced items has remained a priority for Target. They emphasize value, especially those lower-priced items you often see at the front of the store, the $1, $3, $5 section, also known as the bullseye playground. They are committed to keeping the same prices in that part of the store and plan to add more impulse-friendly items there, like mini beauty products and trendy snacks and drinks, to capture that value-seeking shopper. CEO Brian Cornell stated that Target will use its scale to help it stay price competitive with other retailers. He also mentioned that Target is constantly adjusting pricing, with some items going up and some being reduced, as an ongoing effort that takes place each and every day. Given the unclear long-term level of tariffs, Target is contemplating a wide range of potential scenarios and building plans to preserve maximum flexibility while protecting its business in the face of massive potential costs. When asked by reporters for specifics on tariff-related price increases, Cornell did not provide them. For context, other retailers are also grappling with this. Walmart has warned it may have to raise prices due to duties, while Home Depot indicated it doesn't plan to hike most prices, but may increase prices on select items or eliminate product lines. There was also some talk about customer reactions to internal company decisions impacting sales. Yes, that came up too. Apparently, there was some customer backlash after Target made updates to key diversity, equity, and inclusion, or DEI, initiatives back in January. This decision reportedly angered supporters of diversity and inclusion policies who felt blindsided, especially given Target's previous positioning as a champion of diversity initiatives and LGBTQ rights. According to the reports, this decision actually affected sales, and CEO Brian Cornell mentioned the reaction to the updates on belonging as one of the headwinds faced this quarter. There was even a 40-day consumer boycott organized in response, led by Rev Jamal Bryant, a prominent Atlanta area pastor, with other Black leaders like Rev Al Sharpton supporting boycott efforts. Protesters picketed outside Target headquarters. Some analysts suggested Target came under more pressure than other companies that rolled back DEI policies because Target had gone further in its DEI efforts and has a more progressive customer base than some competitors. This really underscores how these non-economic factors, like brand perception and alignment with consumer values, can play a role too. CEO Brian Cornell did send an email to staff acknowledging it had been a tough few months between the retail economy headlines, social media, and conversations, stating that Target's culture and commitment to staff had not changed and that the company remained the Target you know and believe in. Inventory levels also seem to have been a challenge coming into the quarter. Inventory levels were reportedly up over 7% at the end of the fourth quarter, and higher inventory can mean higher holding costs and often leads to more markdowns later to clear out the excess stock, which then pressures your profit margins. Getting that balance right is always tricky in retail. Target CFO Jim Lee mentioned some higher first-quarter costs related to reducing inventory, such as through markdowns, because of slower demand. On top of all this, Target themselves had anticipated some outsized profit pressures in Q1 just from the startup costs of opening new stores and ongoing remodel projects. Okay, so that's a look at the challenges, a mix of broad economic factors, consumer behavior shifts, and some company-specific elements. But it wasn't all negative, right? Were there any bright spots or positive initiatives? Oh, for sure, there were definitely positives to highlight. We already mentioned the digital side showing strength, with 4.7% growth in digital comparable sales. Exactly. And within that, their same-day delivery services, powered by the Target Circle 360 program, saw really impressive growth, over 35%. Wow, over 35%. So people really value that convenience. It certainly seems that way. Those investments in quick, convenient fulfillment look like they're paying off and resonating with customers. Any other successes? Partnerships, maybe? Yes, they highlighted their collaboration with Kate Spade. It was called out as potentially their strongest designer collaboration in more than a decade. That's high praise. Those collaborations can definitely drive traffic and excitement. They really can. Even if they are limited-time events, they create buzz. Were there specific product areas doing well despite the overall caution? Yes, they actually gained market share in a few key areas, like beauty sales, which saw nearly 7% growth in share gains, and apparel, which grew share over the last 3 quarters. In the first quarter specifically, Target gained market share in categories like beverages, floral, and produce. Okay, more essential categories perhaps? Possibly. They also saw stronger sales in things like women's swimwear and toddler clothing. And they noted good traffic spikes around holidays like Valentine's Day and Easter, suggesting they can still capture shoppers for specific occasions or needs. Target's digital business overall is quite large, a $20 billion business that saw nearly 9% growth in Q4. Their Target Plus marketplace is a $1 billion marketplace growing at a double-digit pace, with more than 35% growth in third-party GMV last year and expected to reach $5 billion in GMV over the next 5 years. Their Roundel ad business is also seeing mid-teens growth. Traffic growth overall saw 2% plus growth in Q4 and a 20% uptick since 2019. Their loyalty program, Target Circle, has seen significant growth, adding 13 million members in 2024. That's a huge pool of customers they can gather data from and engage with more directly. Strategically, what are they doing internally to tackle these challenges and push for growth? One big move is creating a new Enterprise Acceleration Office. Okay, what's that about? It's going to be overseen by their Chief Operating Officer, Michael Fidelke, and the goal seems to be enabling faster decisions and execution, simplifying company operations, using technology in new ways, and basically speeding up Target's growth plans. Kind of an internal efficiency and growth engine. Any leadership changes alongside that? There are a couple of notable departures announced: the Chief Legal and Compliance Officer, Amy Tu, and the Chief Strategy and Growth Officer, Christina Hennington. Moves like that can sometimes signal a strategic refocus. Target also plans to open more than 20 new stores in 2025. And looking ahead, what are their investment plans like for the year? They're still planning significant investment. Capital expenditures, or CapEx, are expected to be somewhere between $4 billion and $5 billion in 2025. Wow, that's a lot. Where's that going? Primarily into stores, which includes remodels and perhaps some new ones, strengthening their supply chain further, and investing in technology to support both online and physical retail operations to enhance the consumer experience. They are also expecting a modest increase in the operating margin rate in 2025, and they plan to recommend a low single-digit increase in the quarterly dividend. Okay, so putting all of that together, the Q1 performance, the influencing factors, the strategies, how has this impacted their financial forecast for the rest of fiscal 2025? Well, they've had to adjust their expectations downwards. They're now anticipating a low single-digit percentage decline in sales for the full year. This is a notable shift compared to previously expecting growth. Yeah, their earlier forecast was for about 1% net sales growth. Adjusted EPS expectations have also been lowered. The new range is projected to be approximately $7 to $9 per share. That's down from the previous range of $8.80 to $9.80. Their GAAP EPS forecast is now between $8 and $10, so a more cautious outlook overall. But are they expecting things to improve later in the year? They did indicate an expectation for greater cost relief, maybe easing pressures, in the second half of the year. So perhaps anticipating a slightly better environment or their own initiatives kicking in more effectively then. What about analyst forecasts for the stock? Based on one-year price targets offered by 31 analysts, the average target price for Target Corp is $116.61. The high estimate is $160, and the low estimate is $82. The average target implies an upside of 18.85% from the current price of $98.12. Based on the consensus recommendation from 39 brokerage firms, Target Corp's average brokerage recommendation is currently 2.6, indicating hold status. The rating scale ranges from 1 to 5, where 1 signifies strong buy and 5 denotes sell. There's also an estimate from Guru Focus. Their estimated GS value for Target Corp in 1 year is $154.26, suggesting a potential upside of 57.22% from the current price of $98.12. GF value is Guru Focus's estimate of the fair value that the stock should be traded at, calculated based on the historical multiples the stock has traded at previously, past business growth, and future estimates of business performance. So there's a bit of a range in price targets and valuation estimates out there. In pre-market trading following the earnings report, the stock saw a decrease of 4%, bringing its price down to $94.50. Target shares dropped more than 5% in morning trading after the report. The stock is down over 27% this year and has fallen more than 38% over the past 12 months. Let's step back for a moment. For those of you listening who are maybe in finance, retail analysis, or business strategy, what are the absolute key takeaways from all this? I think the main thing is that Target is clearly in a challenging phase right now. You see it in the declining sales, the earnings missing expectations when adjusted for one-time gains, and obviously the lowered forecast for the year ahead. And it's not just one thing causing this, right? It's multiple factors. Exactly. It's really a confluence of things hitting them. You've got the broader issue of weaker consumer spending on non-essentials due to economic uncertainty. That's specific uncertainty around potential tariffs, adding significant cost worries and potential pricing pressure. You have the challenges related to managing inventory in this environment, and then the ripple effects from some of their own strategic choices, like those related to the DEI program changes, which have impacted their business. They are also facing a tough competitive environment where they are losing market share in many categories. So, how is the company fundamentally trying to steer through this? What's the high-level response? Well, you see structural moves like creating that Enterprise Acceleration Office, overseen by the COO. That, combined with the executive shuffles, points towards a concerted effort to become more agile and more efficient operationally, trying to better respond to these market pressures and accelerate growth. They are also actively working to mitigate tariff impacts through sourcing adjustments and vendor negotiations. They are investing heavily, between $4 billion and $5 billion in 2025, into their stores, supply chain, and technology to enhance the consumer experience and support long-term growth. But we shouldn't forget the positives either, should we? No, definitely not. It's crucial to balance the picture. They are still seeing solid growth in digital sales, especially their same-day delivery services, which is key for the future. The growth in their Target Circle loyalty program is also a significant positive, providing a large base of engaged customers. And successes like that Kate Spade collaboration show they can still generate excitement and draw customers in specific ways. These are potential bright spots that could help offset some of the headwinds. So, summing it up for a professional audience, it's a complex situation. Challenges are clear, driven by external economic factors, potential tariffs, and internal strategic decision impacts. But they're actively maneuvering, implementing strategic initiatives, investing in their business, and seeing some areas of strength, particularly in digital. Target is navigating a very tricky environment. Their success in the coming quarters is really going to hinge on how effectively they adapt their strategies, especially around managing costs like tariffs, where they source goods from, and how they connect and engage with their customer base in this cautious spending environment. It's going to be critical to watch. It really is a fascinating case study. You see Target grappling with this complex mix, broad economic trends hitting consumer wallets, specific industry pressures like tariffs, and their own strategic decisions, all interacting. It definitely makes you think about how these dynamics play out across the entire retail sector, doesn't it? It really does. It highlights the constant balancing act these large retailers face. Well, thank you for breaking all of that down for us, from the Q1 numbers and the reasons behind them, to the strategic responses and the revised outlook. It's given us a lot to consider. Target's story is still unfolding, and we'll be keeping a close eye on how they navigate these challenges in the quarters ahead. Thank you all for tuning in to Financial Podcast today. If you found this discussion valuable, please do hit that like button and subscribe for more analyses like this one. We appreciate you listening. We'll be back soon to explore another important topic. Until then, thank you and goodbye.